All right, very good evening, students. Today we are going to talk about chapter 3 in accountancy. I believe all of you may have gone through the discussion that we have had on chapter 1 and 2. So, this is an important chapter from conceptual understanding perspective. I believe everything we are going to cover will be of great help for all of you, not only to understand, but as well apply them whenever needed. So let us understand the topic. So here we have we have classified it into two. One is theory base of accounting, which we are going to take up today. And the next one is accounting standard and Indian accounting standard, which we will cover up tomorrow. So the first one we will start with. Now here if you look at session 1, I have divided it into two parts. One is accounting principles, wherein there are 5 points which we will be discussing at length today. The second session 2, these are the points which we will be taking it up tomorrow. So I'll go to session 1 today and we will have a discussion on this. Now what it says here, meaning and nature of accounting principle. How this term has come and why it is needed. First of all, we have to understand, I'll give you some briefing, that there are so many entities which are there across the globe, and every one of them is required to maintain the accounting of the transactions which are done. Now, it is important for all of us to understand that if every one of them happens to have their own sweet will to practice the accounting, then there will be a lot of chaos. We will not be able to understand it with what objective or what process a particular A entity has maintained the account, what process B has followed. There will be a lot of confusion. Therefore, some premises are laid in order to help everyone understand that within these framework the entities are going to record their transactions. What are the frameworks, to what an extent it is flexible, and how it is going to help us have a great piece of information through the accounting information that is provided, we will be studying here. These principles we are going to understand today, so that whenever we happen to look at the financial statement of a company or any entity, keeping this in our mind, we can accordingly assess them in a more effective way. Let's see what are they. Now, the first one, what it says here, principles of accounting are general law or a rule accepted, adopted, or proposed as a guide to action, a settled ground or basis of conduct or practice. So major part of discussion here, what it says, which is given by American Institute of Certified Public Accountant, what it says that principles of accounting are general law. So it is not a scientific law or principle. It is a general law or rule adopted or put into practice, proposed as a guide to action. So the law is standing, or the general principle is standing as a guide to action. Action is with regard to following the accounting practices, a settled ground or basis of conduct or practice. So I hope this particular definition to a larger extent covers that there is no rigidity on it. Rather, it is a matter of practice, which is at the ease of the practitioner, but ultimate objective is that the reports serve the purpose of the user, and there is similarity as per the principle. Now let us see, these principles are classified into two categories. Now category 1, which is accounting concepts. These are basis, assumption or fundamental propositions within which accounting operates. They are generally accepted principles. So it is very simple, categorically stated. Accounting concepts, they are generally accepted rules. So A accountant, B accountant, C accountant, D accountant, all of them by and large follow these basic assumptions or fundamentals before going ahead with accounting practices. There is also convention, accounting convention. Convention is nothing but, let's say, an entity which has been following an accounting process for years. So that is what is his convention of following the accounting, and these are the outcome of accounting practices or principles being followed by the enterprises over a period of time. So these are accounting. There are two categories. One is concepts, which is largely followed, and the other one, which is convention. A particular entity may have its own convention of following accounting principles or accounting processes, that is separated into second part. Let us furthermore understand how it works out. So we will see here. Now, features of accounting principles. What are the features? Now, accounting principles are man-made. Now, it is not something which is naturally done. It is man-made. So, group of people who thought this is what is largely acceptable. So, they developed the principles based on practical experiences that they have in maintaining the accounts. Second is accounting principles are flexible. Now it is not very rigid. Not that once done is done forever or one practiced is practiced forever. It changes time to time. Even government also intervenes into accounting practices by laying down certain principles. Then accounting principles are generally accepted. As I said, it is the people with experiences have made, and therefore it is largely accepted principle. Now, the general acceptance of these three accounting processes depends on how it meets the three following criteria. Now, general acceptance is usually depending upon the first criteria, which is relevant. So it has to be, the principles are to be relevant. If it is not relevant to the objective with which the accounting is prepared, it defies the purpose. So relevant accounting is what required. Then it meets the objective, means the purpose for which it is prepared. It is not the interest of the person who is doing it. That does not matter there. What exactly has happened basis the transactions which have taken place and the objective with which the accounting practices are being followed, it has to meet the objective, not biasness or not biased by individuals' intention. Third is feasible without complexity. So principles should be feasible, not rigid. There should not be too much of complexity. So these are the basic understanding about how the accounting principles should be and what criterias it should meet in order to have a good accounting principles. Let us see further. Now here, necessity of accounting principle. Now, why do we need them? Though by and large we have touched upon why it is required, because otherwise there will not be uniformity. But here the understanding a little more deeper, what it says, accounting information is better understood if it is prepared following a set of accounting principles for uniformity. Now this is important, that there has to be uniformity. Unless there is uniformity in the practices, then it will not meet the purpose. Means same principles are followed by all entries in preparing their final account. Now let us see the next one, fundamental accounting assumptions. Now there are two things. One is assumption, the other one is principle. Now assumption, when I say, it is implied that, or it is presumed that every accountant follows these assumptions. Principles means it is a guidelines or theory which guides an accountant the way process is to be followed. So that is to be understood. So here we are discussing the concepts or assumptions. Accounting information is better understood if it is prepared following the set of accounting principles, so that there is uniformity and there is no diversity. Everyone follows the same. Assumptions which are presumed to have been followed in preparing the annual accounts, the entities which do not follow any of the fundamental accounting assumptions are required to disclose which of these are not followed, and there are reasons for not following. So, as I said, that these are largely assumed to be practiced. So, if it is assumed that in a particular way the accounting process is to be executed, or it's to be practiced, in that case it has to be the same way. If it is not, then there has to be a disclosure of information in the final account, that uh, as a note, that why such and such practices are followed, why such and such practices are not followed. So this is to be clearly mentioned there in the books of account. Now let us see the next one. Now there are three important assumptions. First is going concern assumption. Now, what is going concern assumption? Now, basis which we have to follow the accounting principle. So, be going concern means an institution or an entity, when it started with an intention of continuing it for a longer period of time, foreseeable future. So it knows that how long it is going to continue and it is going to exist. So it is not with an intention of closing it the next day. It is always with an intention that it is going to be there for a longer period of time. Now, from accounting perspective, we have already discussed the two terms revenue and capital. So when we talk about these two terms have come up on the ground that the accounting follows the principle of going concern. As I said, that if a particular, let us say, advertisement expenditure, or for example, which is done, the benefit of which is going to derive for 4 or 5 years, it is not 1 year that gets consumed. So if any particular on this basis the categorization is done, say supposingly, if assets are bought, now buying an asset is a capital expenditure. What is the intention assumption behind? The assumption is that the asset is going to be there in the organization for a particular commercial viable time period. On that basis we have treated it as a capital expenditure, not a revenue expenditure. Similarly, a revenue expenditure, benefit of that particular expenditure which is going to be derived within an year or so, within an year, 12 months time, it is to be treated as a revenue expenditure. So therefore it is understood that the organization is going to continue for a longer period of time, but there is a foreseeable future. So accordingly, the books of accounts are maintained and capital or revenue expenditures are accordingly treated. Had this not been the case, even a capital nature expenditure is to be considered, will be considered in a particular year, which does not give us a proper result. Therefore, we have to assume that the whole, the asset that has been bought, it is going to give us benefit for a longer period of time. Now, there is consistency assumption. Now, what is this consistency assumption? The organization is going to continue for a longer period, consistently going to be there, in the sense that the practices that we follow, say for example depreciation, if in a particular year there are two methods of depreciation, that is written down value method and straight line method. Anyhow, you need not understand at this point of time what are these two. But if suppose for understanding sake, if the organization is following straight line method, then it has to follow, that is a consistency which he has to show. Otherwise, 1 month or 1 year it is charging single straight line method, the other way written down method, that confuses. So it is important that there has to be consistency. It is assumed that the practices are consistent. Accrual assumption. Now there is third one, which is transactions which are recorded when they are entered in, whether amount is exchanged or not, in the sense that supposingly if goods are sold, there is a cash that has been received. There may be a situation that goods are sold but cash is not received. So revenue is generated by selling the goods. Whether there is cash received or not received is immaterial on the ground of principle or concept of accrual assumption, that if not this year, next year we will receive the cash, but it is to be sales or revenue is to be treated for the current year. So that is very important. Asset purchase on credit. We have bought the on asset, brought into the business, is to be entered in the business account, and we have to show it as an asset. Correspondingly, if it is on credit, there has to be a liability. So liability will also be shown in the liability side for buying on credit assets. But whether money is paid or not, yet it is entered in the books of account as an asset. Service given but not received, money not received. If you are a service provider, service is given, money is not received, no matter. It will be treated as a revenue in the revenue for the organization. Attempts will be made to collect the cash, that is a subsequent level of effort. But from accounting perspective, since the sales or service has happened, it is to be in a particular time frame, it has to be treated as revenue for the current year. So in only these we are doing only basis these three assumptions, which is large everyone follow. So that is why it is important that every accounting practitioners happen to follow this. Now let us see something furthermore. One side we have discussed about the basic assumption or concepts. Now here the other assumptions, which are principles as per the theory of accounting, it is principle which is to be followed. So accounting entity or business entity principle. Now what is this entry? When it comes to entity, entries are recorded in the books of account from the point of view of business. Now in the sense that it is, if we happen to classify the individual entity of a businessman and business, then only accounting entries can be done. Say, for example, a businessman who has put in money to his business, it is a liability for the business because it is a separate entity. It has taken money from the businessman, and it becomes the responsibility of the business to return the money to the businessman. Though in practical scenario it does not happen, he takes the profit for the capital that he has invested. So accounting entity, businessman and business are two different entities. But when it comes to a sole proprietorship, who is himself managing the business and is an owner of a business, from accounting perspective, both business and businessman is different. But from outsider's perspective, he cannot tell to a creditor who has given him money that I am different and my firm is different. So you go and take money from my firm. That is not a judicious or a right statement to be given from an honor. So from practical perspective, it is not, they are not separate, but from accounting perspective, they are two different entities. Basis that every entry is made because business has taken money in the form of capital, it gives the profit back to the owner. Money measurement principle. Now, this is also very important that anything that can be measured in terms of money can only be recorded in the books of account. Now, however good or efficient the management team is there, it may have an impact of corresponding revenue growth in the organization, yet that that is a qualitative aspect of management which cannot be entered in the books of accounts. So transactions or events that can be measured in terms of money are only to be recorded. One cannot say that because of a talented team of managers, my growth has happened, so I'm going to add some revenue on the ground that my talented team has given revenue. No, it gets already reflected in sales. So therefore, money, anything that can be correspondingly assessed, any transaction that can be correspondingly assessed in terms of money can only be recorded in the books of account. I hope this is understood. Now, accounting period principle. Now, what is this accounting period? No businessman is interested in knowing that I am starting a business with 1 lakh rupees. When I close the business, how much of profit I'll be having. That's not a very scientific understanding. In fact, the whole time period of business is divided into a smaller time frame so that the progress of the business can be assessed. Now that is why usually it is 12 months, January till 31st December. Some organizations follow this as their financial year, which happens to be calendar year as well. The second one is maybe there is no hard and fast rule, but 1st July till 30th June, that may be also business year they may follow. Some follows 1st April to 31st March. So usually 1st April to 31st March happens to be the largely accepted accounting period for majority of the organizations. So these are the three principles that we have seen. Now let us see the fourth one, full disclosure principle. Now what is this full disclosure principle? Disclosure in the books of account should be there with regard to any transaction that is happening. So disclosure should be made of items required under law. If law wants to submit certain set of information in the books of account, it is required to be disclosed, which are material for the users. If it may be for the legal people as well, it may be for the people at large. Say, for example, if a particular plant in an organization is kept on shut down for a longer period of time, maybe 6 months or so, this is a material decision for the users of the accounting information who have invested or are likely to invest in the company. So this is required to be published for the as a notice or as an attachment for the larger mass of the people who have interest in accounting information of that particular company, so that they are informed before making the decision. That is a material aspect which is important to be communicated. I hope this is clear. So anything which is related to which is related to an organization which is material for the investor or outsider or user of the accounts, it requires to have a full disclosure. Okay, so this is full disclosure principle as per the law, but there may be certain things which may not be material. For example, if the size of an organization which is 10 crore 15 crore, don't rigidly go by number, but let us say, so it's a big organization. Now if the revenue is 10 crore per annum, for an organization which has a revenue big enough, if there is a small expenditure which it does, it may, or let's say expenditure in terms of renovation of the building, office building, this will be put up in the accounts but need not be a disclosure, because that is not a very material information to be passed on to the users of account or investor. But supposingly, if it is a smaller set of organization which does 1 crore or 2 crore rupees of revenue, and if it has a spend, say 2000 or 2 lakh or 5 lakh or 10 lakh rupees on building renovation, that is a material information. So alongside the accounting information, there has to be a disclosure that such and such major expenditure has taken place. I hope this is understood. Now, materiality principle. So, an item or disclosure is material if it will influence the decision of the user. So, this is what we have understood. Anything which is material, it requires to be communicated. Prudence or conservatism principle. Now, this provides an anticipated expenses or losses. Usually, you will come to know as you progress further bad debts. So if goods are sold on credit, the buyers of the goods out of the total lot, if certain percentage, the businessman thinks that it is not going to come back. So on the assumption that it is going to be a loss, they create a reserve out of the profit. So that in case situationally such losses happen as bad debt, there is already a ready fund to meet the loss. So this is a conservatism. So being conservative, that losses are likely to happen. Being conservative, that profits are not going to go too high. If it happens, that's fine, but we cannot uh, do accounting keeping in mind that profits are going to be too high or losses are to be ignored. It is what the principle of conservatism. So let us see the next one, where we will see the seventh principle, cost concept or historical cost concept. Now here what it says that whenever a particular asset is bought in an organization, there is a cost price. Now and if it is presumed that that particular asset has its commercial life of 10 years, then there is likelihood of depreciation every year to be charged. Now there are methods of depreciation that we are not talking about. Now we have bought a particular asset at, let's say, 1 lakh rupees, 10% depreciation every year. Likelihood of its commercial viability of the asset is 10 years, so 10,000 rupees every year as a depreciation, which is going to be deducted. There may be a situation that market value of that particular asset may have fluctuated. So our book value may be showing after 2 years 80,000 value, but market value may be 90,000 or 1 lakh of that particular asset. So we are going by historical cost concept, not expecting or not considering the changes in the market price, which may have gone higher or lower. We are rigidly following the same process of depreciation which we have been following, and books are shown cost price minus depreciation. Matching concept or matching principles. Now, expenses incurred to earn the revenue should be recognized as expenses in the year of revenue is recognized. That means, so if there is a particular set of expenditure, correspondingly there is a revenue. Say if we have hired sales team, so there is a sales team expenditure, salary in salary terms, but they would have brought in some business as well in that period. So it is a matching concept or matching principle which says that for the current year, if there is an expenditure, what is the corresponding gain or revenue associated with that? Both are to be taken into consideration with a matching principle. Dual aspects or duality principle. Now, every transaction entered into books of accounts, which is, we all know it is double entry system of bookkeeping. So every transaction has dual aspect. You purchase goods from A. If you have bought certain goods from A, that means A account is involved and goods are also involved or purchases are involved. So so entries will be made in purchases as well as into in A's account. If it is purchase on cash, cash entry will be made as well as purchase entry will be made. So dual aspect principle, it is not that only purchases are made, so purchase will be entered and there will not be a corresponding entry. So this is also a very important principle of accounting, basis which the whole process of accounting gets followed. I hope it is understood. Now, accounting principle, the 10th one, revenue recognition concept. Now, what it means, revenue is recognized when right to receive is established. Now, very simple. Let us understand. When I when a businessman happens to get the right of revenue, say, for example, if he has sold goods on credit, he has the right to receive the money back. If he has provided, if it is a service entity, if it has provided service, it has a right to receive money. If it has availed the services, it has the right to pay money. So revenue recognition concept is realized when the right to receive is established. It is not that when cash is received, sales are made, sales done on credit, cash has not come, nothing, business has not received anything, but in the books of account, sales will be treated as revenue. Cash is immaterial. So there has to be a revenue recognition. If it is established, it has to be entered irrespective of the fact whether there is corresponding cash received or not. Verifiable objective concept. Now, transactions are recorded on the basis of evidence. Now, various organizations you must have heard of, there are sales team, and they every month they have to submit a expenditure report for the field visits. Now, these expenditure reports, certain things which are very minimum, less than 100 capping is given by the company or 50, no voucher, corresponding voucher is required, so that will get through. But there are certain expenditures for which in corresponding invoice is required to be given along with your expense claim. Why it is so? Because the entries can only be made only when there is corresponding documents which is verifiable, and if it gets established that it is rightly done, then the entries will be made in the books of accounts. So there is a evidence needs to be established. So every entry there has to be a corresponding evidences in terms of invoices, vouchers, bills. So all these which are important information or important evidences for an accountant to record the transaction in the books of account. So I hope this is understood. Now let us see the next one, accounting standards. So anyway, there are accounting standards we will be touching in detail in the next session, because otherwise it is going to be too long. So I would expect all of you, whatever we have discussed today, you can, or you must have taken note of, or you can go through the video again and again in order to understand the concept, because the whole lot of accounting that you are going to do as a commerce student, it is based on these principles, not only from theory perspective, but as well from its practical utility. Therefore, you read as many times as possible so that you happen to get the feel of its correct understanding. You don't need to remember anything. All that you need is to understand it and understand the concept so well that when there is corresponding application based questions which are likely to come as we progress further, if your understanding, conceptual understanding has been good enough, then there will not be any problem with regard to applying those concepts. And that is why it is important for all of you go through these in a very appropriate way, learning from keeping in mind that you have to learn and understand all these concepts because they happen to be the basis of accounting. So I thank you all for listening to me, and I would expect those who are listening, if you are if you have liked the whole discussion, I would appreciate or appeal you to like my channel, wherein I'll be coming up with lot many such videos at length. I would also expect you to subscribe and share to your other students who are there in your locality so that they also happen to take the advantage of this discussion and do good from accounting perspective. And most important thing which I would always seek for from all of you, that you make a mention in the feedback in comment, because every single feedback or your comment is of great value for us, and I would certainly go through them and try to work out if there is any suggestion which you have made with regard to incorporation of the discussions that we are going to make. It would be a great value. Or else, if you require anything furthermore, you can make a mention. I will try to incorporate. Thank you so very much. It was wonderful talking to you all. My good wishes to every single student who is going to appear for the exam. Thank you so very much.